The Fed announced today on Wednesday that it would begin reducing its asset purchase program in November later this month. The reduction would include $10 billion less in Treasurys and $5 billion less in mortgage-backed securities. We're here to discuss market impacts of this decision with Gary Wagner. He is the editor of thegoldforecast.com. Gary, it's been a while. Welcome back to Kitco.
Thanks for having me. It is good to be here.
Yeah, it's been a while since we spoke because I've been traveling and we hadn't had a chance to catch up. So we will be getting your outlook on gold, medium and long term into 2022. But first, I want to get your reaction to the Fed. So I know you've got some statements prepared that you like to address, but this is a snippet that I'm pulling out here from the statement released today. The inflation is elevated, largely reflecting factors that are expected to be transitory, the statement said. Supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to sizable price increases in some sectors. And so I think the Fed is still sticking to its transitory inflation narrative, but they've conceded that it's about time to taper back a little bit. Your reaction to today's statements?
Well, absolutely. They did state that they will begin tapering. As you said, they'll be tapering $10 billion each month on U.S. debt and $5 billion a month on the mortgage-backed securities, which means that they announced they'll start this month. They will not be finished till June. But what I found most interesting is kind of between the lines, because what Chairman Powell said during the press conference is that they are willing to adjust the level of tapering, not so much the timeline, but the amount each month to reflect any changes in the economic condition, which to me is a lot more dovish than prior statements. He also, as you said, acknowledged that inflation is much hotter than he had believed it would be, and it will last longer than he believed it would be. So in terms of, and he also said in the question and answer period, they asked about raising interest rates, liftoff. And he says that doesn't meet the test yet, and we're not even doing the test. Now, the earliest they could begin to raise rates would be after the tapering process is complete, because to taper and reduce or raise rates at the same time would be tantamount to a disaster. That would be too much for the economy to handle. Mm-hmm. So I'm still looking at flexibility in the level at which they taper. And the timeline was left very, very ambiguous as to when they would initiate liftoff. And to me, that was a much more dovish Fed than we have heard in the past.
It is interesting how he noted that, Fed Chair Jerome Powell noted that inflation is still transitory, but he's prolonged the transitory timeline, so to speak. Listen to this. He said, our baseline expectation is that supply chain bottlenecks and shortages will persist well into next year and elevated inflation as well. As the pandemic supply chain bottlenecks will abate and growth will move up. And as that happens, inflation will decline from today's elevated levels. So he's basically saying that he is recognizing inflation has been sticky, but he's saying that this is due to, again, supply crunch issues that will likely persist into next year. So do you agree with that statement, that supply chain issues are still going to be around with us until 2022?
Well, I believe that they will. I believe he is correct in saying that much of the inflationary pressures, and we're at record levels, you've got to go back to 2008 to find the last time we had inflation at this high of a level. But food and energy costs, which are typically stripped out of the PCE, they are in the CPI, which is right now at 5.3%. I believe the PCE is at 4.4%. For the first time, he acknowledged that inflation is running much hotter than their 2% target. I mean, it's obvious, but he hasn't made that statement, so he's acknowledging that. I still believe components of why we're having this high inflation rate will be sustained for a period of time. I don't see oil going down too much very quickly. And as far as food costs go, I don't think it's related only to the shipping bottleneck, getting them to the proper places. And for that reason, I think he recognizes that this is going to be a persistent problem that lasts well into at least the middle of 2022. and possibly all the way to the end of 2022.
Right. Now, Gary, let's talk about the timing of this tapering. Do you think that the Fed is making this decision at this meeting because of inflationary fears, or do you think it's because the economy, in their opinion, has already been growing at a sufficiently fast pace such that it's back on track and it warrants some sort of tapering? Which is it?
Well, I don't believe he with any kind of a straight face say that the economy is back on track. Third quarter GDP was released, I believe, last week at 2%. Now, that's for the third quarter. The second quarter came in at a 6.7%, a really robust GDP. So that kind of contraction is not indicative of an economic expansion, quite the opposite. So he's acknowledging that inflation is running hotter, but he cannot with any straight face say that our economy is growing to levels that are acceptable to begin tapering. I think the Fed painted themselves into a corner, and they announced the initiation of tapering. It's that caveat they put in, which is we will adjust it if needed. I think they're pulling the trigger too soon. But again, the most important part of what he said about tapering is not that they would begin, it's that they would adjust it if needed. And that's going to really come down to what the GDP is in the fourth quarter and, of course, Friday's jobs report, because he spoke about the fact that we are nowhere near going to maximum employment at this time.
That's right. And we'll need maximum employment before they begin liftoff. Now, I want to talk about the taper tantrum. All throughout the summer, the Fed has been hinting of a tapering timeline. They finally are putting this into place. Why hasn't the markets, why hasn't the S&P 500, for example, reacted negatively to the news? Back in 2013, we saw a taper tantrum, but just today, for example, the S&P 500 closed at new all-time highs.
Yeah, it's interesting. Most of the major indices were down before the announcement, and then they began to recoup and go up and to close. Any higher close, of course, would be a new record high in the S&P and in the Dow. I think that the reaction was not so much that the market participants involved in the equities markets felt comfortable with the beginning of tapering. I think that it was largely factored into the market ahead of time. And that's the reason we didn't see the market really tank in terms of U.S. equities.
Well, how much of last year's rally in equities would you say has been caused by quantitative easing?
A huge percent. Money is almost costless to borrow, so you can have companies that can expand, and expansion in companies leading to greater sales, of course, will in fact move stocks higher.
So that's kind of my point. So you're taking that away. You're taking that liquidity away. Well, not completely away, but you're drawing it down a little bit. That's the point of tapering. Why wouldn't that affect the markets negatively? Why wouldn't you're taking the juice out of the system, yet we're still breaching new all-time highs? Does that make sense to you?
Well, yeah, here's my take. He said that they're going to begin not quantitative easing. They will begin to taper. They'll taper at the amount they said, $15 billion per month. But they also said there's been flexibility. But he made a statement after that. And he said, once we complete tapering, we still have a tremendous amount of assets in our balance sheet that will support high liquidity in the market. In other words, he's not talking about reducing the $8.6 trillion asset sheet that he has.
Right.
And so his statement saying, look, even though we're going to stop buying and adding to our balance sheet is big enough that it will support the liquidity needed and the cash needed for economic recovery and expansion. And I think that was the key.
So are they on track for a liftoff next year, do you think?
If the data supports it, I think that they might be, but they don't want to make the mistake that they made in 2009 and began to increase interest rates too quickly. but they're very low. They might raise rates, but only do it in a mild way, maybe 0.25% or 0.5%. But the minimum, they won't even talk about raising rates till June because they will not taper and raise interest rates at the same time. That would be too much on the economy. I think what Powell wants to see is not maximum employment as he claims, but more employment. There are still millions and millions of individuals in America that are still unemployed. Now, some of them have left the workforce and retired. But for the most part, I think we're still at 7 or 8 million. I'm not sure about that fact, unemployed Americans that are seeking jobs.
Several banks, like the Bank of America, for example, are projecting multiple rate hikes next year into 2023, for example. So they're not going to do it all in one go. They're going to do it in increments. Do you see that as a plan?
Correct.
Okay.
Oh, absolutely. Normalization, from my understanding, would take the interest rates or Fed funds rate from 0 to 25 basis points, 0.25%, at a maximum of 3%. And I think that they would do that over a period of years and not months. In other words, once they do begin liftoff and raise rates, they might go 0.25% on a monthly basis, but they're going to do it very slowly. They're also going to have the ability, by doing it very slowly, to see if that's having a detrimental effect, if it's raising them too quickly. So I think that once they do raise rates, it will be extremely methodically slow.
Yeah. And you said the maximum is 3%. Why 3%?
Well, 3% is what Powell has said is what he considers interest rate normalization, maybe 2.5% to 3%.
Right. Okay. Let's talk about. Let's follow up more on this development and see how the markets react to this news. We're seeing today, of course, that the risk-on assets, of course, are not. They're taking this in stride. Let's put it that way. But gold, however, you would expect gold to move up on dovish news. In fact, the U.S. dollar, the DXY index, has in fact fallen sharply after 2 p.m. So you would expect the gold price to move up, but it really hasn't all that much.
You would, and you would also expect gold pricing to move up based on the level of inflationary pressures that we have. It's 4.4 on the PCE and 5.3 on the CPI. That's a tremendous level of inflation. The dollar is buying less. There's no doubt about it. And gold reacted tepidly, if at best, because it was trading down about $23 per ounce prior to the release of the statement. It then moved back to around down 17 to down 15. But one could have expected to see it move from negative to positive, especially with the dollar falling out of bed. I mean, it's a steep decline in the US dollar. And the fact that gold didn't have a nice kick up, even in reflection to the fact that gold and the dollar are paired together, is unusual. The other thing is that inflation is still running high. I don't believe all of the inflationary pressures are transitory. I think that higher costs in food and energy will be with us for a while. And so that's what surprises me. There was a more dovish Fed, the acknowledgement that inflation, whether it's transitory or not, will be more persistent than he believed. In other words, last longer. And he acknowledged that they'll taper, but they're open to adjusting the tapering amount based upon the data he sees. Right. And so I think that what's really important is the jobs report that will come out on Friday, because we've had 2 months of dismal reports that have come in way under estimates. Look, the July numbers that came out in August was 943 million, above expectation of 700,000. Then the following 2 months, they were predicting around 400,000. And the last jobs report came in at, what was that, David? 124, or it was under 200,000 new jobs added. And the prior month before that was also tepid and well below forecast by economists. So
the
it's telling us
just keep
that
getting bolder and bolder. That's the issue. They just keep getting more and more optimistic and harder to beat.
Well, the reality of that, though, is that the scourge that's really been affecting the economy was the Delta variant. It was an unexpected kind of a black swan event. And because of that, they had to adjust everything to that. They remained optimistic, but the facts were that it wasn't backed by the data. Because what Powell said is that there's many people unemployed that are fearful to go back to work. Many people that are still unemployed because they're going to leave the workforce because they don't want to have a chance of getting COVID. Yeah. And we had tremendously high numbers. It was some of the highest numbers during this entire pandemic. The interesting thing is that we've seen a major downtick as shots get into the arm, so to speak. And so here in Hawaii, during the peak of the Delta variant, we were getting 1,000 new cases a month, which is minuscule compared to other states. We're now getting about 60 to 80 new cases every day. So it's gone down tenfold.
Okay, let's talk about gold's performance over the last couple of weeks before we move on to your outlook. Now, I can't help but notice that gold's range has been highly correlated to the range that the real interest rate has been following. So if you compare these two variables together, they've more or less moved range bound. So I'm starting to think that, well, gold isn't really reacting today, or actually hasn't really been moving much at all in the last couple of weeks, simply because the real interest rate hasn't yet, moved in either direction. What do you think?
Correct. I think another factor we definitely need to bring into the equation was the all-time record highs in cryptocurrencies, Ethereum and Bitcoin specifically. So there is a camp or a group of investors that strictly use gold as an inflationary hedge. There's another component to the investment community involved in gold, and that's in terms of speculating in the market. And because Bitcoin has moved up tremendously, that would steal some of that speculative thunder out of it. One. Two, with equities running so hot, that also takes some of the thunder out of the speculative aspect of gold. So I think we're seeing that place pressure. And then lastly, we got up to $1,800 per ounce for a day, came back down, then it went back up in the recent last 2 weeks. And it was reported that the large hedge funds were shorting gold as soon as it hit 1,800. So they've been kind of keeping it at bay and allowing it to move higher. The key numbers to me are, of course, 1,800 effectively on a close, and then 1,835, which was the top that occurred a few months ago, and then above that is 1,920. Those are the levels. In terms of support, we touched near 1,760, and that's a key and critical number.
All right.
And so we have support at various areas, but the support is not as strong as the resistance.
Interesting. So let's tie monetary policy now back into gold. Where do you see gold headed by, let's say, the end of the year first?
I think that if the jobs report comes in as weak as the prior 2 months, that should ignite some interest again in gold. Absolutely. If it comes in extremely robust, that's going to give evidence that our economy is back on track and now recovering. And that, of course, would take away a lot of bullish sentiment. So that's a key number that the Fed, as well as all market participants, will watch. And then the second thing is, we're not that far away from getting numbers on fourth quarter GDP. If it remains tepid, 2%, 3%, I think gold could really move, but it's going to be based on the data.
Interesting. Okay, let's move on to the following year then. Let's assume that inflation continues to run hot, and let's also assume that economic growth doesn't really pick up substantially from the 2% we saw in quarter three. That would imply that we're in a stagflationary environment. How would you expect gold to react in that kind of a macro landscape?
If that is the case, and I believe we are currently in stagflation because it is the absolute definition of what stagflation is. High inflationary rates, a lot of need for more people in the labor force is definitely going to, at some point, come back and ignite gold. Then there's another thing that we haven't even spoken about. We talked about the fact that the Federal Reserve balance sheet is 8.6, but it is our national debt that has grown substantially. It's basically doubled since the pandemic. And at some point, that's got to get dealt with, or maybe not, because this is a new way of looking at economics where you just print money to get us out of a recession. But I think at some point that's going to come and bite them in the tail, so to speak, and that would move gold higher. And that's what I believe might happen.
All right. Well, I'm getting the sense that you're moderately bullish, or at least you're more bullish than bearish, at least in the medium to long term. Is that fair to conclude?
I am cautiously bullish, medium to long term. Mm-hmm. I am looking at the facts short term, and that is it isn't moving on what I would consider to be bullish news.
And so for the traders watching, key levels that gold really needs to break out of this week or next?
1,800, that's the first level. On top of that is 1,835.
And what's the support level? What's the floor at which you would be concerned if it reaches that level or breaches that level, it could fall further perhaps?
Well, we've already broken close to 1760, but the brass ring in terms of negativity is 1680. We have had 1680 was the double bottom in March. It was a bottom after the flash crash. There's been a lot of historical data that every time it hit that point, it bounced off of it. Now, Do I believe it will get that low? I personally don't, but this has been a very difficult market to read.
Mm-hmm. Okay. Well, we'll have to see where interest rates go, because let's assume that inflation continues to run hot, then the interest rate component would determine where real interest rates go. Well, Gary, let's follow up some more as the Fed story develops, and we'll have you back on to give an update. Thank you very much for coming today.
Pleasure, as always, to be here.
And thank you for watching Kitco News. I'm David Lin.